It's hard to question anything that Nvidia or Jensen Huang have done over the past decade, maybe even 3 decades. But one thing that I think investors really need to think about is the company's buybacks. In the recent pace of buybacks, they're buying back about $10 billion in stock per quarter, and the price that they're paying for those buybacks. A recently announced $50 billion buyback program is open-ended, but it's very possible that that's exhausted very quickly at the current stock price. Now, if you think the stock is going higher, that's obviously a great use of capital. But if we look back historically, Nvidia is trading at historically high multiples. And typically, that is not when you want to be buying back stock. You want to be buying back stock when it's trading at a discount to the market, when it's undervalued compared to competitors, or when you're at a low point in the market. Nvidia has actually done that in the past, but I don't think that's what they're doing today. And I think a better use of that capital would be either to just keep it on the balance sheet, save it for a rainy day, let's say if revenue does go down in the future and there's more opportunistic prices to buy the stock back, or to just have a decent cash hoard on the balance sheet. The other thing to think about with Nvidia is, where are these buybacks going? Are buybacks actually reducing the number of shares outstanding? Or are they just a backdoor way to pay employees rather than just putting that cost on the income statement? I want to dig into all of that today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go to the announcement. This is from earlier this week. Nvidia reported second quarter fiscal 2025 results. Results are really good, so I don't have any complaints about what the company is doing from an operational perspective. But within these results, you had this right here. During the first half of fiscal 2025, Nvidia returned $15.4 billion to shareholders through the form of repurchased shares and cash dividends. As of the end of the quarter, the company had $7.5 billion remaining under its share repurchase authorization. The board of directors approved an additional $50 billion in share repurchases without expiration. So now look at this number here. So far this year, in the first 6 months of the year, $15.4 billion returned to shareholders. So what you would expect there is that the share count is declining. Is that the case? This is the company's annual filing. As of February 16th, 2024, there were 2.5 billion shares outstanding of Nvidia stock. Now there was a 1-for-10 stock split, so there are now twice as many shares outstanding today. So what's the most recent number of shares outstanding? As of August 23rd, 2024, 24.53 billion, or if you round to the same number of significant digits that we had from the annual filing, this is 2.5 billion shares outstanding. So the company bought back stock, but the number of shares outstanding did not decline significantly. This is not new for Nvidia. This chart shows about $43 billion worth of buybacks in the last 3 years. And you can see that in total, the number of shares outstanding over that period of time were down 2.1%. So a tremendous amount of buybacks, but not impacting the number of shares outstanding very much. Why is that? Well, it's because of this right here, stock-based compensation. You can see that stock-based compensation has grown at a compound annual growth rate of 41% since 2015. So just an incredibly high growth rate. There are 2 ways that you can compensate employees with stock. You can give them restricted stock units. That's basically just giving them shares of stock, and they have limits on when they can sell that stock. If you want to offset that, you do a buyback. So you issue stock as an RSU, and then you do a buyback. The other alternative would just be to pay the employee an equivalent amount of money, and they could buy the stock if they wanted. Typically what happens with RSUs is once they are exercisable, the employee exercises them and sells the stock. And that's in part because it's a form of compensation. Why wouldn't you sell the stock if that's part of your compensation? The other option would be to give stock options. That is the option to buy a price at the current share price, and you usually have about 10 years to buy that stock. So if you were given stock options in Nvidia stock in 2014 and those expired this year, you could have had a tremendous gain on that stock, but that would also increase the shares outstanding, and the cash coming into Nvidia would be relatively small because the exercise price of those options is relatively low. So you would have dilution because of those stock options, even if they were granted years ago. What it appears Nvidia is doing is to offset both of those forms of stock-based compensation. They are simply buying back stock. So this sounds great, buying back $50 billion worth of stock, but what you're really doing is most of those buybacks are just offsetting dilution that you have from stock-based compensation for paying employees. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Why else would you not want to be buying back stock right now? Well, the stock is relatively expensive, no matter how you look at it. Here's a few different ways to look at how expensive Nvidia stock is. This is the price to sales multiple. You can see that that is nearly 30. That is just an astronomically high price to sales multiple for any stock. And if you go back to 2015, the price to sales multiple was about 2. So the compound annual growth rate of the price to sales multiple is about the same compound annual growth rate as Nvidia's revenue. 30% CAGR there for price to sales multiple. The price to earnings multiple is a little bit more reasonable at 55 times earnings, but you can see that that's been much, much lower in the past. 20, 25 times earnings if you go back to 2015. It's also been much higher in 2023 when the company was actually lapping some write-downs. But again, a 55 price to earnings multiple is pretty high, especially when you consider that Nvidia's margins have expanded to astronomical levels, 76% gross margin in the last 12 months. So are they going to be able to maintain that for the foreseeable future, for the next year or two? Probably. They have been talking about that margins are going to come down a little bit. But if those margins go back to a more reasonable level between 50 and 60%, then that price to earnings multiple would look significantly higher than it is today. And the final multiple to look at is just price to free cash flow. This is pretty similar to the price to earnings, but you can see that that's about 62 right now. So a pretty high price to free cash flow multiple. Now, like I said, if everything goes really well for Nvidia, if AI demand explodes, if companies are building trillion-dollar data centers, of course, this is going to be a great time to buy back stock. But if there's any sort of pullback in the capital expenditures, particularly the hyperscalers are making over the next couple of years, then we could see Nvidia's stock pull back pretty significantly, and there's a history of this. Nvidia has a history of their stock drawing down or falling from their highs 50, 70, 80%, and does this periodically throughout each decade. We are now obviously at a high, so is buying back stock at that high the right thing to do, or should they wait for some sort of pullback? The business is also very cyclical. There are often huge waves in Nvidia's revenue depending on what's going on in the market. So there was the Bitcoin wave, and then that fell off. There was the Ethereum proof of work wave, and then that fell off. Now there's this AI wave. We don't know if or when that is going to fall off. So again, I think the thing to consider for Nvidia is why are they buying back stock, and why are they buying back stock right now? It looks like they are certainly buying back stock to offset compensation that they have given employees. I think that is generally a terrible reason to be buying back stock because that's not really a buyback. That's not really reducing the shares outstanding. The other thing is the timing of these stock buybacks. They're obviously doing this because they have excess cash on the balance sheet, but would that excess cash be used better simply paying a dividend or a special dividend maybe, or even waiting for a rainy day when demand does go down and the stock falls potentially, and then you can buy back at a much lower price. I think this is the one big flaw for Nvidia right now, because if the stock does pull back, let's say we have one of these 80% pullbacks and the stock goes to $20, $30 per share, this $50 billion will likely be out the door, and that will not be something the company is going to be able to get back. So something to think about for investors. Like I said, everything's going well with Nvidia's operations today, but it doesn't mean it's going to go well forever. So I think buying back this stock at a very high price, not necessarily the best thing to do. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.